there is a profound, almost suffocating psychological whiplash taking hold of the global economy right now. We are watching a very dangerous, intoxicating narrative violently collide with cold, undeniable mathematical reality. For the past 18 months, the financial media and politicians have been selling you a comforting story. They told you to just hold on a little bit longer. They promised that the Federal Reserve was about to pivot, that interest rates were going to plummet, that inflation was a conquered beast, and that the era of free, easy money was about to resume. Millions of hardworking people believed this story. They stretched their budgets, they kept their 20% credit card debt floating, and they bought wildly overpriced assets, assuming that a sudden wave of cheap credit was going to wash over the economy and bail them out. But look at the reality of what is happening in the markets right now. The Federal Reserve recently concluded its policy meeting and held the benchmark interest rate absolutely steady at 3.50% to 3.75%. Why? Because a massive geopolitical shock has shattered their timeline. We are watching a sustained conflict unfold in the Middle East. Brent crude oil has surged to levels hovering around $115 a barrel. This oil shock has embedded inflation even deeper into the global supply chain, forcing the Fed to actually raise its inflation projections for the end of 2026. The central banks are caught in a terrifying trap. Job growth is weakening, and we are watching the Russell 2000, the index tracking smaller companies, plunge into correction territory as businesses suffocate under the weight of higher borrowing costs. The pressure to cut rates is immense, but if they drop rates now while oil is spiking, the cost of living will explode into the stratosphere because they are caught in this stagflation trap. You, the average worker, the saver, the consumer, are becoming the collateral damage. But I want you to listen to me very carefully. Do not make the fatal mistake of thinking this is simply a 2026 problem. I have spent the better part of 8 decades analyzing the machinery of global capitalism. I traded through the devastating inflation spirals of the 1970s, the euphoric delusions of the 1999 dot-com bubble, and the credit collapse of 2008. The faces on television change. The geopolitical catalysts change. The names of the politicians change. But the underlying mechanics of wealth transfer remain exactly the same. What we are witnessing today is a timeless historical cycle. Whenever a society prints trillions of units of fiat currency to fund its deficits, that currency eventually collides with the physical limits of the real world, like the supply of oil. When that collision happens, the middle class is always wiped out, and the ownership class always absorbs the wealth. Today, we are going to have a brutal, unapologetic conversation about the reality of your money. I am going to tear down the mirage of the modern economy. I will expose the 5 specific financial illusions that are bursting right now. And then, I am going to give you the exact eternal protocol that the truly wealthy have used for a century to shield their fortunes from volatility and systematically acquire the productive assets of the world while everyone else is panicking. This will be a dense and demanding masterclass. It requires you to silence your emotions and look at your balance sheet with clinical objectivity. But if you execute what I am about to share, you will completely rewrite your financial destiny. Let us begin by dissecting the environment. We must expose the 5 timeless illusions that are keeping you broke. The first illusion is the mirage of the macro rescue. The entire middle-class strategy for the last 2 years has been based on procrastination. People are carrying variable rate mortgages, massive auto loans, and staggering credit balances because they are convinced that the government or the central bank is going to save them. They are waiting for Jerome Powell or the incoming Fed Chair Kevin Warsh or the president to magically lower interest rates and make their financial anxiety vanish. This is a fundamental misunderstanding of history. When energy prices spike and inflation is structurally embedded into raw materials, the cost of borrowing money must remain elevated to fight it. If you are sitting on high-interest consumer debt, waiting for the Federal Reserve to save you, you are committing mathematical suicide. You must realize that nobody is coming to rescue your balance sheet. The era of 0% interest rates was a historical anomaly, and relying on its return is a fool's errand. The second illusion is the blind worship of market concentration. The most dangerous moment in investing is never a crash. It is unwarranted confidence. Despite the geopolitical headwinds and the reality of sticky inflation, retail investors continue to pour their life savings into a handful of technology companies at valuations that defy all historical logic. A massive portion of the S&P 500's entire value is currently tied up in a handful of tech giants. When you buy a standard index fund today, you're making a massive top-heavy bet on very specific companies trading at extreme multiples. When you buy a stock trading at 40 or 50 times earnings, you are paying for decades of flawless growth up front. In a world where supply chains are threatened by war and interest rates are locked in the high threes, flawless growth is mathematically improbable. I want to buy wonderful companies when they are priced like average companies. Buying wildly overvalued assets simply because the price went up last month is not investing. It is speculation. The third illusion is the hoarding of melting ice, saving fiat currency. The financial industry loves to sell you the illusion of the high-yield savings account. They proudly offer you a modest return on your money, and you feel brilliant for taking advantage of it. That sounds responsible until you understand the physics of fiat currency during a supply shock. When a central bank expands the money supply to fund deficits, they do not create new wealth. They simply dilute the purchasing power of every single unit of currency that already exists. If your bank pays you a 4% yield, but the real rate of inflation is being pushed past that by $100+ oil, your safe investment is generating a guaranteed negative real return. You are paying the bank a fee every single year for the privilege of holding your money while it evaporates. Cash is not a long-term asset. Cash is a melting ice cube. The fourth illusion is the ignorance of institutional flight. While the average retail investor is glued to the daily movements of the stock market, the most powerful and systemic financial institutions in the world are executing a completely different strategy. They are quietly engaging in a massive flight to hard assets. Look at what global central banks have been doing over the last 2 years. They have been accumulating physical gold at a near-record pace. Why are the very institutions that create money out of thin-air stockpiling a 5,000-year-old metal? Because they understand the mathematical impossibility of repaying global sovereign debt honestly in an environment of permanently higher interest rates. When debt becomes unmanageable, governments inflate their way out. Gold is the only reserve asset that is not simultaneously someone else's liability. When the architects of the financial system are buying hard assets, ignoring their actions is a fatal error. The fifth illusion is the normalization of destructive leverage. We live in a society that has normalized financial servitude. The middle class has been trained to ignore the total cost of an item and focus exclusively on the monthly payment. When you finance a depreciating asset, a luxury car, a vacation, a designer wardrobe, at exorbitant interest rates, you are mathematically destroying your future. Compound interest is the absolute law of financial physics. When you invest, it builds empires. When you borrow for consumption, it builds prisons. There is no legitimate investment on earth that will guarantee you the return required to outpace 20% credit card debt. If you are financing a lifestyle you cannot afford in cash, you are not a consumer. You are the product being consumed by the banks. We have shattered the illusions. The comforting narratives have evaporated. You are now standing in the desert of economic reality. It is stark and it is unforgiving, but it can be navigated. If you want to survive the stagflation trap, you must stop operating like a frantic emotional consumer and start operating like a rational, heavily capitalized financial institution. You must adopt the architecture of accumulation. This is the exact, timeless protocol to build a fortress that cannot be breached by inflation, war, or market corrections. Protocol 1. The eradication of destructive leverage. You cannot build a skyscraper on a foundation of quicksand. You must attack your high-interest consumer debt with unyielding fury. Downsize, sell what you don't need, and reclaim your monthly cash flow from the banking sector. The wealthy do not pay interest on consumer goods. They use debt exclusively as a tool of leverage to acquire cash-flowing, productive assets. Until your consumer debt is zero, you are entirely vulnerable. Protocol 2. The construction of the liquidity moat. Once your destructive debt is eradicated, you must build an impenetrable wall between your family and the chaos of the economy. Maintain at least 6 months of essential survival expenses in highly liquid form. I always keep massive amounts of cash available, not because I love holding cash, but because cash gives you options when others have none. When small cap stocks enter a correction, or when the broader market drops because of a geopolitical shock, you do not panic. You do not sell your world-class businesses at a devastating loss just to pay for groceries. You live comfortably out of your liquidity moat, entirely detached from the panic of the masses. You use the excess cash to buy great businesses when they finally go on sale. Yes, this cash will lose some purchasing power to inflation. That is the cost of security and optionality. Protocol 3. The aggressive accumulation of the gap. Wealth is created in the margins. The speed at which you reach financial sovereignty is determined by one metric, the gap. You must spend less than you earn by a significant margin. The average household saves a tiny fraction of their income, keeping them on a treadmill going nowhere. Wealthy households maintain savings rates of 20%, 30%, or even 50% of their income, regardless of how much they earn. I still live in the same house I bought in 1958. Every dollar you spend on ego is a dollar that cannot work for you. Find ways to increase your gap by at least 10% immediately. Cut subscriptions. Reduce transportation costs. The first $100,000 is the hardest money you will ever make. Get there as fast as you can, and then let compounding take over. Protocol 4. The systematic execution of ownership. With your fortress built and your gap expanding, you must transition from a consumer of goods to an owner of production. You must own assets that produce real returns above inflation. Real assets are ownership stakes in productive enterprises. When you own shares in a company, you own a piece of a business with employees working every day to create value. For most people, the simplest way to own productive assets is through low-cost index funds that track broad market indices. You must automate this entire process. Human beings are terrible at making consistent financial decisions when the news is terrifying. Set up automatic transfers so money moves to your investments immediately after every paycheck. Let the system do what you designed it to do. The wealthy don't have superhuman discipline. They have systems that make discipline unnecessary. Protocol 5. The cultivation of the intellectual moat. The final pillar of accumulation is the one asset that no central bank can inflate away and no oil shock can steal from you. Your mind. I read for hours every single day. This habit compounds exactly like interest. In a ruthless global marketplace, you are paid based on how much value you create and how irreplaceable you are. You must build an intellectual moat around yourself. Become deeply, painfully specialized in solving complex problems. Identify one skill that increases your market value and commit to developing it. Focus creates expertise, and expertise commands premium pay. The transition from a vulnerable earner to an untouchable owner is not a magical event. It is the result of thousands of small, boring, highly disciplined choices made consistently over a long period of time. It is setting up the automated transfer into the index fund and having the stoic fortitude to never turn it off, regardless of what the Federal Reserve does or what happens with global oil prices. The economic realities of 2026 are harsh, but the math of wealth creation is eternal. Armed with the truth, this does not have to be a tragedy. It can be your defining moment of absolute financial liberation. Subscribe to this channel. We are going to continue navigating these turbulent economic waters together. We will ignore the macroeconomic noise. We will focus entirely on the cold, rational mechanics of wealth creation, and we will build empires that last for generations. Let's get to work.